I'm very glad to be joined by Leo Haviland today to talk about government debt and how it affects all of us. So let me properly introduce and welcome Leo. Leo, welcome to the program.
David, thank you very much. It's an honor to be on your show.
Excellent. Glad you're with us. So the introduction, Leo, first let me say, Leo, you're the person I go to when I want to understand more about some of the macroeconomics of how our economy and our country function, especially when it comes to debt and currencies. So I'm really glad you can be with us. Leo is a economist and a business consultant, has worked on Wall Street, Goldman Sachs, and many other Wall Street institutions, does a lot of consulting work and looks at things from a macroeconomic standpoint, which I don't always have the luxury of doing, Leo, so I appreciate your perspective. University of Chicago, all right, and Cornell Law School.
That too.
Okay, and 3 decades.
That's a long time.
That's a long time. Well, we appreciate your expertise. So let's dive into this very important subject, government debt. You know, I think for a lot of Americans, they see maybe a TV commercial about it. Oh, our debt is this much now. And as you know, it continues to increase. How does that debt really affect everyday Americans? That's really what I want to get to with you. So let's start with the debt, you know, 20 trillion. I mean, I have a hard time getting $1 trillion in my mind. I can handle $1 billion, but $1 trillion. So these numbers are really astronomical.
Yes, they're huge. And an important element in the size of the debt is because we're all citizens, this is our debt. And you can divide it by the number of citizens, the number of people in the country, but we all have a substantial obligation, and that needs to be underlined.
All right.
And it ties into, as you indicate, David, other marketplaces, stocks, other areas of the interest rate world, like mortgages.
Okay.
Commodities, the dollar, and all those things matter to us as citizens and to us as business persons and to us who are doing individual financial planning.
Okay, well, we'll connect the dots for everybody on that, because I think for a lot of people, they hear that and they go, Leo, okay, I hear you, but I don't understand how we connect that to my personal finances. So we'll take maybe a step at a time. As that debt goes up, and it does concern people, and I want people to know at home that we're not saying, let's pull the fire alarm and do something rash and take every nickel you have and put it in gold or go buy survivalist gear and move to the mountains. We're not saying that. But what we are saying is it does need to be considered. So let's connect the dots. So as our debt increases as a country, and I'm not going to do the math of how much we all individually owe in effect by this total debt, but when we look at that, that affects things like, we'll start with mortgage rates. The translation is that as the debt goes up, there may be a need for rates to rise in order to induce investors to buy the debt.
That's correct.
So with that, that means that the rate might be higher, and then, okay, that means there's going to be more taxes to be paid later, but how that affects mortgage rates?
It does, because mortgages and other interest rates typically have their relationship or yields priced in relation to what's happening in the U.S. government note and bond marketplaces. So as U.S. rates, and for that matter, government rates abroad shift, that affects what happens in our mortgages.
Okay, so if to put it succinctly, if mortgage rates are linked to Treasury and U.S. debt, and our government has to pay a higher rate, not only are we going to end up paying more in taxes ultimately to pay the extra interest, but we are also going to pay more in mortgage interest on our mortgages. So we almost pay twice, plus the potential impact on the dollar.
That's true.
That's not good. Okay, so we won't get into the political aspects as I promised, but the reality is that these things all trickle through. Now, there's another thing that I have to ask you, Leo, and I know that the viewing audience would want me to talk to you about this, and that is this whole thing about the debt. Who owns it? Does it really matter who owns our debt? There's 20-some trillion. Does it matter if a foreign government or investors or whoever is the one that owns that debt and is receiving the payment and the interest?
It does matter, David. Of the debt total that you mentioned, one owner is the Federal Reserve, who has about $2.5 trillion.
Okay.
So after we look at the Federal Reserve, 2 categories come up. One are let's say, domestic Americans,
Okay.
persons on the street and American institutions, and the others are foreigners. And the foreigners break down into both the general public, and then it's the official institutions like central banks and so forth.
Okay.
And currently, the central banks overseas or other official institutions own perhaps $4 trillion out of the $6 trillion that are held by foreigners in general.
Okay.
So that's over 40%, the $6 trillion of the 14 trillion in public debt out there. So it does matter who owns it and what they decide to do with it.
Well, and the one that comes to mind, which is of course almost always in the news, is China. And so China owns or controls, say, $1.5 trillion. Okay, so the worry that people have is that China would call up and say, hey, you owe us this money, we want it back now, almost like they're coming to your door demanding payment. Can they really do that?
Well, in a free marketplace, if China, and most of the Chinese debt is probably held officially,
Right.
sold all the treasury bills, notes, and bonds they had, that would have a dramatic effect on U.S. and, for that matter, interest rates. They would spike.
Okay, so they can't demand the payment, but they can sell the debt that they own, the loans that they're holding on our government debt. They can sell it in the free marketplace, and by putting that much money, that much debt for sale, if you will, that would cause rates to rise in general pretty quickly?
Right. Well, much will depend on whether there are happy and willing other buyers of those
That's the key.
sales.
Yeah.
And it's unlikely that China would sell the whole trillion or even a large part of it all at once. However, they might reduce their rate of buying of the debt.
Good point.
And if they were either net sellers or reduced net buyers, that would have an effect on U.S. interest rates, all else equal, because someone has to buy our debt, and as you point out, the U.S. government, which is all of us, is issuing more of it.
Right. Well, and so we've got roughly, and I know this number will vary year to year, but we've got roughly $500 billion each year that we've got to fill the gap between what we take in taxes and what we spend. And so we have to have somebody to buy that debt. So if so how does the perception about our having, as a country, our financial house in order, how does that affect? I mean, could at some point the foreign or domestic buyer say, you know what, you've got a lot of debt, we're thinking we're going to want more interest. You're not such a sweetheart, safe place as we used to think you were.
Various factors intertwine to guide individuals and countries' decisions on that. One consideration would be the assessment of the quality of the country's leadership and how divided the country is.
Okay.
The more challenging the political situation here is, the less inclined both domestic and especially foreigners might be to hold American securities.
Okay.
Another consideration would be if particularly the foreigners felt that the dollar was likely to start depreciating after having gone up on balance for most of the past 6 years. That also could cause interest rates to go up because they'd have to be paid a premium to want to own the debt.
Yeah, so tumult, uncertainty, disruption, political transitions, all of those things weigh on the potential buyers of our debt.
Yes.
So when we have this political divide, which I think you're kind of referred to, Leo, and our country, you know, at different times is more politically divided than others. Is that a fair statement?
You're right.
So with that doesn't necessarily send the best, I don't know, stability, perception or message to people that might buy our debt. But the thing that I guess that we have as maybe a little bit of a security or a little bit of an offset that I would love for you to comment on, and that's the relative safety. The relative safety of our debt versus, say, for example, a Spain, or in the more extreme, a Greece, where we are, as a country, our debt still perceived to be kind of, quote unquote, the safest place in town?
Many would say it. Those who are more critical could say we may be the best of the worst.
Okay. best of the worst. The cup is half empty, the cup is half full. All right, so those are all things that as we sit back and we watch the politics and we watch all this unfold, this all does really impact us, both in terms of future taxation and in terms of the impact it has on our debt that we use. And, you know, the thing that I've always found interesting is the impact on mortgages, which we talked about a minute ago. You know, if rates go up, for example, U.S. debt by, say, 1%, which you would agree is certainly possible, that translates to higher interest rates on mortgages, which translates to a higher payment or less of a value of a home you can buy for the same payment.
Right.
I mean, that affects all of us.
Right. And also, because in America in particular, consumers are indebted in ways outside of mortgages, whether it's auto loans or credit cards, that higher debt levels in the federal sector, if it's translated into higher interest rates elsewhere, affects Americans and others in their other debt situations. Another field to consider is because so many Americans own stocks,
Right.
that sustained rising interest rates here likely could have a very damaging effect on stock market prices and perhaps inducing a bear market.
We don't want that. Do something about that, Leo. I don't want a bear market.
My prayers are not working in any dimension, David.
Okay. Well, with that reality, and I know I understand where you're coming from, because the interest rates, of course, can affect companies and how they finance their operations and the amount of expansion they will do, whether they'll build that new factory and create jobs here in America, or whether they might look at doing it overseas.
Right.
You know, there's a lot of things there, but also it affects their profitability, and the profitability of a company directly affects, ultimately, they call that the fundamentals, right?
Yes.
Ultimately affects the value of companies, which translates to the value of your 401k.
Absolutely.
All very intertwined. You must spend just days at a time thinking about how all this stuff intertwines.
Well, and the game changes as it moves forward, so it is very challenging for all of us.
So what are some of the practical steps? You know, this is what everybody's waiting on us to say, Leo. Okay, here's what you do. Some of the practical steps, would you say, would include not only paying attention, of course, but being more diversified and looking at how these changes could affect your portfolios and your personal finances?
Diversification is excellent, particularly given such a complex and multipolar world where what's going on overseas is affecting us here. So being involved in a number of different marketplaces as an asset holder, whether it's mortgages, equities, some commodities, and paying attention to dollar trends all matter.
So a portfolio that may include some bonds, may include stocks. You might use mutual funds. You might decide to do some rental property. You might decide to hold, you mentioned some commodities and or precious metals. We haven't really gotten into the aspects here of that, and we'll probably need to cover that separately, but the dollar and the strengthening of that and how that affects all those things together. So much of this comes together. Is it fair to say that if we stay diversified, that we stand a good chance of, quote unquote, weathering the storm?
Well, diversification helps unless there's bear market trends in several of the
If everything goes down, right? That's what they call that, rearranging the chairs on the Titanic?
Well, that means calling for help or figuring, why didn't I get out?
Yeah. Well, and that's another point that a lot of times people will ask me about is, or they'll say, you know, can't we just take the money out when things go down? Can't we just shift to cash and then wait for it to start to go back up and push the money back in?
Well, there are those who frequently, at the right time and quite wisely, have said that cash is king. In the current environment where many Americans and others have earned an awful lot of money from the stock marketplace rally of the past few years, they should strongly consider levels at which they would sell out of a substantial amount of their portfolio, whether it's if prices went a bit higher or if they started going lower, because nothing grows to the sky.
That's true. There is no historical precedence, which everybody wants to look at what happened in the past, but there is no historical precedence for an unending bull market. They always come to an end, and corrections in bull markets are definitely a frequent occurrence in the past. That's fair to say.
Yes.
But you made a real key point that I want our viewers to really hold on to, Leo, and that is the cash is king. You should always hold cash, at least for part of your portfolio, no matter how good things look, right? And then the other thing is to think about those gains you've had and evaluate whether or not you want to take some money off the table.
You're right.
Yeah, I think that's
Absolutely.
the key. Okay, good. So, Leo, thank you very much for being with us.
Thanks for having me on your show, David.
Pleasure.
It's a
Leo
pleasure.
Haviland, ladies and gentlemen.
Thank you.
Thank you.
If you would like more information about the topics and our guests featured in this series, please visit our website at planstrongertv.com. Also, if you have a question you would like David to answer, please send it to questions@planstrongertv.com.